Looking at just one time frame in trading is like trying to read a book by looking at a single word. It leaves out the full picture. The market has layers, and each time frame reveals a different part of the story. A setup that looks perfect on a 15-minute chart might actually be a trap if the higher time frame says otherwise. But when the higher time frame gives the direction, the middle time frame offers the setup, and the lower time frame nails the precise entry, that's where true confidence and confluence come in. And that is the edge most beginners miss. In this video, we'll explore the concept of multi-time frame analysis and why it's a powerful tool for traders at every level. You'll learn what multi-time frame analysis is, why different time frames hold different meanings for different types of traders, and how various time frames work together to give you a clearer market perspective. We'll also uncover the power of confluence across time frames, when multiple signals align to strengthen your trading decisions. And finally, I'll share practical tips to help you apply multi-time frame analysis effectively in your own trading strategy. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. Multi-time frame analysis is a trading technique where you analyze the same market or currency pair across multiple time frames to get a broader and more accurate understanding of the market trend, structure, and potential trade entries. Instead of relying on just one chart, this method helps you assess the market from different perspectives, from the broader trend to the finer details, allowing you to make better, more informed trading decisions. Let's break down how different types of traders use different time frames in multi-time frame analysis. Scalpers are ultra-short-term traders. They often use the 1-hour, 15-minute, and 5-minute charts to analyze the bigger picture, identify setups, and pinpoint precise entries. Intraday traders open and close trades within the same day. They typically analyze the 4-hour, 1-hour, and 15-minute charts to align with the day's trend and refine their execution. Swing traders hold trades for several days to weeks. Their analysis usually involves the daily, 4-hour, and 1-hour charts, allowing them to spot larger market moves and time their entries more effectively. Position traders are long-term traders, holding positions for weeks or even months. They rely on the monthly, weekly, daily, and sometimes 4-hour charts to understand the macro trend and key levels. The same chart can be a high timeframe for one trader, and a low timeframe for another. So choosing your time frames depends entirely on your trading style, goals, and how much time you can commit to market analysis. Now that you know what multi-time frame analysis is and how different traders use it, let's understand how different time frames work together. Multi-time frame analysis start with the higher time frame. In this time frame we look for the overall market trend. Is it trending up, trending down, or moving sideways? Mark key support and resistance zones, trend lines, or major levels. This gives you the directional bias. Then comes the middle time frame, which acts as the bridge between the higher view and the execution. This is where you look for trade setups. You'll observe whether price is respecting the key levels you marked on the higher time frame. It's also where patterns like pullbacks, consolidations, flags, or supply and demand zones become more visible. This time frame helps you pinpoint the area of interest, the zone where you may be looking to take a trade. Finally, the lower time frame is where precision matters most. Here, you zoom in to fine-tune your entry. You're looking for price action confirmations such as candlestick patterns, breakouts, fakeouts, or trendline rejections. This is the moment where you decide, is this the right time to enter? When these three time frames align, the higher time frame gives the direction, the middle time frame gives the setup, and the lower time frame gives the trigger. That's when you have a high probability trading opportunity. Now let's talk about one of the biggest advantages of multi-time frame analysis, the power of confluence. When the higher time frame gives the direction, the middle time frame gives the setup, and the lower time frame gives the precise entry, that's when you have a high probability trading opportunity. Because multiple layers of analysis are supporting the same idea. You're no longer relying on a single candlestick or signal, you're stacking probabilities in your favor. Confluence simply means that multiple signals or conditions align across different time frames, pointing in the same direction. To get the most out of multi-time frame analysis, here are some essential tips every trader should follow. First, always start with the higher time frame. This gives you a clear view of the overall market direction, whether it's trending up, down, or moving sideways. Think of it as setting your GPS before starting the journey. Second, keep your time frames consistent with your trading style. For example, an intraday trader might use the 4-hour chart as the higher time frame, 1 hour as the middle, and 15-minute for entries. Don't mix time frames randomly, your analysis should flow logically. Third, use the middle time frame to identify potential trading setups. This is where you'll find things like pullbacks, chart patterns, or price reacting to key levels. It's your signal to get ready. Fourth, drop down to the lower time frame only to fine-tune your entries. Look for precise triggers like candlestick patterns or breakouts that align with what you saw on the higher time frames. Fifth, avoid analysis paralysis. Too many time frames can lead to conflicting signals and missed opportunities. Stick to 3, 1 for trend direction, 1 for setup confirmation, and 1 for entry. Finally, always look for confluence, when all your selected time frames agree on direction and signals. That's where the highest probability trades exist. Mastering these tips will help you bring structure, clarity, and confidence to your trading decisions using multi-time frame analysis. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.